Standard geometric patterns and retail indicators often prove unreliable because they ignore the high-level logic governing large-scale price delivery. To understand the source of this logic, we look at the actual scale of the playing field. The global foreign exchange market processes approximately $7 trillion every single day. Within this volume, the Continuous Linked Settlement, or CLS group, handles the settlement of roughly $6.5 trillion daily. Moving and settling such a massive, centralized volume requires extreme precision. To maintain this efficiency, price delivery is managed through high-frequency algorithms and automated banking systems. Navigating this environment requires moving past retail patterns and decoding the actual institutional framework, market narrative context, and institutional order flow. Every institutional price cycle begins with consolidation. This is the period of accumulation, where orders are built within a defined range. Algorithms treat ranges as liquidity, targeting stop-loss clusters outside. Upon finding volume, the market expands. Price breaks out, engaging buy stops. This displacement leaves a footprint, an order block. The final red candle preceding the breakout marks the origin point of the institutional capital injection. The expansion phase identifies a specific direction of displacement, providing the first measurable institutional reference point on the chart. Following an expansion, the market enters phase 3, retracement. The algorithm must eventually pull price back to rebalance the move. Retracements target internal liquidity. Rapid breakouts create a fair value gap, an inefficiency from one-sided trading. Institutions optimize pricing by buying in the lower discount zone, where our gap sits. The algorithm returns price here, rebalancing the inefficiency at wholesale levels before continuing the trend. These pullbacks represent a systematic rebalancing of the algorithmic delivery, allowing for position building at optimal price levels. The final phase is the reversal. This is a deliberate shift in directional bias, typically achieved by targeting an existing liquidity pool. As price approaches this old high, it pokes briefly above it to trigger breakout buy orders. Once that liquidity is engaged, the market rapidly shifts in the opposite direction. These shifts are often timed to coincide with high-impact institutional news events. This provides the necessary volatility to move large positions without excessive slippage. These macro events include CPI inflation data, non-farm payroll reports, or interest rate decisions from the Federal Reserve. These rapid shifts represent a systematic transition of liquidity, timed to coincide with the influx of orders during high-volatility news events. This Euro-USD chart displays how these four signatures function together. A high-probability setup requires analyzing consolidation, expansion, retracement, and reversal in a unified sequence. At the peak of the reversal, we see the alert for a CPI news spike. This provides our narrative context, confirming that institutional volume was used to reach a premium zone. Zooming in reveals the footprint left by that move, a fair value gap. When price returns to rebalance that gap, it confirms the algorithmic flow and offers a specific entry point. A valid trade setup requires both macro narrative context and a specific institutional reference point in the order flow. Train your eyes to recognize these four algorithmic signatures. Once you understand the system of delivery, you can move away from retail speculation and begin anticipating institutional price action.